On the one hand, the Fed is pretty tight. If you look at technical things like the Fed funds versus interest on excess reserves, or if you look at this, what they call cross-currency basis, how hard it is to obtain dollars if you're trying to hedge your bond exposure overseas. The Fed is pretty tight, but the Fed really has no choice, and they have to keep going until something breaks, and what will happen is the market will break before the Fed reacts. So no, I'm not stepping into this.
What does break mean? What do you mean the market has to break?
Well, I would say a major correction around 15% would make me a little more interesting in this market.
That gets Powell's attention?
No, I think Powell would need a little more than that. He said in the last press conference that unleveraged assets like stocks are of less interest to the Fed than leveraged assets like bonds and CLOs. Until you see spreads widen, I don't know that the Fed would be that alarmed by the stock market. It's just as we found out last February when former New York Fed president said the 10% decline through February was small potatoes.
That's reassuring. David, where are you on this and the degree to which asset prices coming down is doing some of the Fed's work for them?
I think it definitely is, and I think the Fed's actually probably watching a lot more closely than that. I think they've got a message from the equity market, and maybe some of the Fed officials that are have a few more political biases are probably happy with what's going on, but I don't think that's the mainstream committee. And I really believe that Jay Powell made a pretty serious communication error back on October 3rd, and that's really what this whole correction is about. We talked about it last week, I think, on this show or one of the other shows on CNBC, and I think that's really set the stage for people to think about how they're discounting these earnings, which are coming in pretty strong, and it's a decently strong economy, but there are definitely some breaks in interest rate sensitive sectors. And I think Jay just said this comment about being a long way from neutral, and it really threw the bond market off, which then threw the stock market off and created a lot of these jitters. My guess is he walks that back, and we really are not a long way from neutral, and that's going to be a time for a pause at some point next year, and that's really a place where we're going to see another liftoff in risk assets.